in order to kick off the day, what we're going to do now is an exercise of, we called it Viewpoints, I could have called it Fireside Chat. The objective of this session is really to set the stage for the day. And for this exercise, I will have the pleasure of sort of interviewing or interacting with, and not flattering them, but two of the best experts on the topics we're going to be addressing today. David Bradbury on my right, who's the head of the Tax Policy and Statistics Division at the OECD. And we all know the importance of the work done by the OECD on this particular topic. And on my left, Gaëtan Nicodème, who's the head of the Economic Analysis Unit at DG Taxud at the European Commission. Needless to say that the European Commission is, I would say, the other fundamental actor on this topic today, obviously in particular in Europe. So what we're going to do is we have a 75-minute session, and here again, the objective, and this is different from what we will do for the rest of the day, which will be roundtables, is to set the stage for the day. The session is going to be divided in more or less 3 times 25 minutes on 3 big themes. The first theme will be the recent developments in taxation at international and European level. The second theme will be tax competition between countries. And the third theme will be tax challenges arising from digitalization. And really what the exercise we're going to do is, fits very well with what Institut Friedland likes to do, which is think together and try to come up with solutions together, knowing that none of us has all the solutions, but by thinking together, maybe we can make progress. And that's why, our little slogan, action-oriented economic thinking, fits really what we want to do. So let's get going on the first theme, which is about recent developments in taxation at international level. Very, very, very briefly, in 2 or 3 words, because Hervé already, put the landscape. But tax evasions revelations have proliferated in recent years. We all know that this has become a very, very fundamental topic. And in the light of that context, in 2013, David, I'm speaking under your control, the G20 mandated the OECD to launch what was to become the base erosion and profit shifting BEPS project, whose purpose is really to define new international taxation rules in order to enable more effective taxation of international groups, and in essence, to build a tax system on 3 fundamental pillars, which are coherence, substance, and transparency. That was in 2013, and obviously we need to be updated on what's going on, and so many things have been going on. I will not start. That will be David's job to do it in a minute. And obviously, the EU has connected on the BEPS project with the 2 famous ATAD directives in 2016 and 2017, and that must be borne in mind. The other dimension, obviously, in the European context is the context of the Common Consolidated Corporate Tax Base, which we will call for the rest of the day CCCTB. And obviously, as you're all aware, we might be speaking about CCCTB or CCTB, depending on whether we want to consolidate or not. And there will be discussion on that issue of are we dealing with 2 Cs or 3 Cs later during the day. Obviously, the initial ambition of CCCTB in 2011 was very much focused on the competitiveness of companies and making common taxation of corporations an instrument to improve, well, as I just said, the competitiveness of European enterprises. Now, 5 years later, when the proposal came back on the table, that dimension was still, and now I'm speaking under Gaëtan's control, was still fundamental, but there was another dimension, which was obviously to embed in the new proposal for a directive a comprehensive solution to profit shifting. So that's really our context. And now back to, well, not back, but let's go to our expert and start with the questions to them. David, let's start with you. What would you say are the progress that have been made in the implementation of the BEPS package, and what remains to be done today?
Well, thanks very much, Thierry. It's great to be here, and thank you for that excellent introduction. As you said, the BEPS project, the Base Erosion and Profit Shifting project, really kicked off in earnest back in the second half of 2013 when the G20 finance ministers and then the G20 leaders endorsed a package of action items, 15 action items in the BEPS action plan. And it was really over the next 2 years through until October 2015 that the OECD, working very closely with, at that stage, OECD member countries, which we currently have the 35 member countries, but also working on a level footing, an even footing, with each of the G20 countries. And that was important because I think that, and this is where the impetus that the G20 gave to the project was significant, because it really ensured that the work that was being undertaken had a much broader perspective, that those countries that collectively contributed to more than 80% of global GDP were at the table and were contributing on an equal footing. And so in delivering the BEPS package, there were the various reports responding to the 15 action items. And I think that at one level, I think it's fair to say that that was one of the most significant renovations of the international tax system that we've seen in recent years. It wasn't a revolution, but it was a significant renovation. And I think what really was one of the hallmarks of that work was what I think really should be seen as an unprecedented level of international cooperation. And I guess in today's environment where we see just how difficult multilateralism is generally, to think that over the last few years, all of those countries came together and were able to reach agreement by consensus, which is the operating principle that drives the way we work at the OECD, I think that's a significant achievement. Now, that's the delivery of the reports, but obviously putting some reports together, albeit difficult to secure agreement of all those countries, if the reports sit on shelves and that's the end of it, then there's not a lot that has been achieved. But I have to say that contrary to that type of approach, what we've seen with the BEPS package has been an extraordinary degree of action from countries in implementing the measures. Now, a couple of things. Firstly, when the 15 action items were responded to with the reports in 2015, the G20 finance ministers at the time said, well, this is fantastic, but what are you going to do to ensure globally consistent implementation of these measures? And so they then tasked us with the role, the responsibility of going forward and establishing a framework that would be more inclusive, that would even go beyond those G20 and OECD countries. And out of that process emerged a new institution, a new framework, which is the Inclusive Framework on BEPS. Now, the Inclusive Framework on BEPS, it started with a first meeting in Kyoto in Japan back in June 2016. It now has 113 members, so extending further, and almost daily, or if not daily, certainly weekly and monthly, we are seeing new members come and join the Inclusive Framework. So that figure will continue to go up. And once again, each of those members comes to the table on an equal footing, and we continue to operate on the basis of consensus. So I think it's important to understand institutionally what's been happening. In terms of progress and the implementation of the various measures, all countries have committed to support for the entire package, but specifically all countries have committed to implementing the minimum standards. And the minimum standards relate to Action 5, Action 6, Action 13 and Action 14, which I'll talk about each of those actions a little. But before doing that, I should make the point that when you have a look at BEPS implementation generally, and the ATADs are good examples of this, and even more recently the US tax reform, which we'll talk about a bit more later, but certainly there are strong elements of implementation of BEPS measures in the US tax reform, hybrids, CFCs and interest limitation rules. So, it's not just the minimum standards, but clearly the minimum standards are those areas where countries have all agreed to not only implement, but then to subject themselves to a peer review process, which is very rigorous, has been undertaken, or at least commenced in respect of all minimum standards. So just to go through where we're up to with the minimum standards. So Action 5, which is essentially the action dealing with harmful tax practices. The most notable aspect of this work was around the new nexus requirements for IP regimes. Now, it's not just intellectual property regimes, these are for any form of preferential regime, but clearly a big part of the focus has been on the IP regimes. Another element of Action 5 was also a commitment to spontaneously exchange tax rulings on certain high-risk transactions and arrangements, specifically those that had been identified in the context of the BEPS project. So if we look at those two dimensions of Action 5, in terms of the preferential regimes, the Forum on Harmful Tax Practices, which is one of the subsidiary bodies at the OECD that sits under the inclusive framework on BEPS, it has been conducting these peer reviews, and more than 160 regimes have been identified and reviewed. Now, that's a pretty significant exercise when you think about that. And in doing that, we now see that somewhere in the order of around 90 of those regimes are being amended in order to ensure compliance with the nexus requirements that were agreed as part of the BEPS project. So that's significant progress. And in terms of things like patent boxes, there is a separate question to ask about, from a tax policy perspective, how legitimate and effective are they as instruments or tools for attracting investment and innovation. But that wasn't the purpose of the BEPS project. The purpose of the BEPS project was to avoid harmful tax practices. So it's really about setting a minimum standard around how, if you are inclined to put one of these regimes in place, how would you do it in a way that was not going to have spillovers or essentially erode the base of other countries in doing that. So that's progress there. Spontaneous exchange of rulings, more than 11,000 rulings have been identified and they are being exchanged. And if you think, I'm not going to talk about them specifically, but if you think about some of the high profile cases in recent times that have ended up in discussions around state aid type considerations, quite often they have related to rulings, and I think to the extent that moving forward there will be much greater transparency over rulings, we are very much unlikely to experience, I think, the same sorts of difficulties because of that additional transparency that this will bring. Action 6 was in relation to treaty abuse, and that is in terms of the peer reviews, that's the one that is still to come, in the sense that most countries are to some extent relying on the multilateral instrument in order to implement those changes, and the peer reviews of the treaty abuse provisions will begin later this year. And then we have Action 13 and Action 14. Action 13 is country by country reporting, which clearly has been a very high profile issue, particularly in terms of the compliance activities of businesses and the various measures that have had to be put in place to comply with that regime, affecting large multinational groups, but for the first time ensuring that the global affairs of a group are visible to the tax authorities within a particular jurisdiction. I really like to see Action 13 as being a case of, all of a sudden we're drawing open the curtains to allow the tax administration to have a much clearer picture of the complete operations of the multinational. And it would be great to think that open exchange of information between taxpayer and tax administration is something that didn't require that sort of measure. But I think Now that it's being implemented, there's a recognition that it will provide greater transparency and hopefully support the enforcement of tax laws, and in particular from a transfer pricing risk assessment perspective, give tax administrations the information they need. Action 14 is in relation to MAP, mutual agreement procedure, and also other forms of dispute resolution. And what we see there is that we've already conducted 20 reviews. 20 countries have had their regimes reviewed, and we see countries moving towards the minimum standard on MAP. That's also something that some countries are choosing to implement as part of the MLI, but it continues to be an important area where we are not only peer reviewing, but we're tracking the number of outstanding cases, which I think just merely posting on a website the number of outstanding unresolved dispute resolution cases is something that does put pressure on tax administrations and governments to advance these things. Just finally, in terms of what still sits out there ahead of us in terms of progressing the BEPS package, probably the big issue here is still digital taxation. And I know that'll be the subject of discussion later in the session, but I'll just make a couple of brief remarks in saying that I think that if there was one element of the BEPS package, the 15 action items, where we really would have liked to have been able to make more progress than we were able to in the course of the BEPS package, it was Action 1 on addressing the tax challenges of the digitalised economy. No consensus was reached on a credible path forward. We committed to stay at the table and to keep working, and we have done that, and I think, as I'll mention later in the session, I think good progress is being made. But we really came out the back of the BEPS project knowing that in the absence of agreement having been reached, it was inevitable that countries would begin to undertake unilateral measures. Unilateral measures are never good. You know, you're hearing that from a multilateral organisation. You would expect us to say that. But unilateral measures in the international tax context are a recipe for double taxation, or potentially double non-taxation, which is what led to the BEPS project, but I think we're more likely to see double taxation in this context. So trying to find a way forward on the taxation challenges of the digitalisation of the economy, I think will continue to be one of the big and significant issues. The interim report has been delivered, but there will be much more to do on that, and later in the session there'll be much more to say on that as well.
Thank you, David. Very interesting, and I think that multilateral dimension is going to come back during the day, I'm certain. Gaëtan, before we move on to CCCTB, do you want to react on the implementation of the BEPS package in Europe? And then I will ask specific questions on CCCTB.
Yeah, thank you, Thierry. Thank you for the invitation, and it's a pleasure to be here. Indeed, it's important work, and I think that the OECD has paved the way on all of these actions. But I would like also to step back a bit, and I think that one thing that we need to realize also in the environment is the number and tremendous amount of initiatives that have been taken over the last decade. I think that we are living times in taxation that we have maybe never experienced before. There's a new dynamic that has been pushed indeed by many affairs that have been uncovered. I think that has been one of the driving elements. If we look back, for example, there was 2007, 2008, 2009. There was a beginning when I was starting to work in DG Taxute, coming from the ECFIN part. And you had those two scandals. In Germany, you had the Liechtenstein affairs, you know, individuals who had accounts in Liechtenstein, in some trust. You had the UBS affair in the US. And this prompted, it was the middle of the financial crisis, really the hardest moment, that also led to reactions, because there was a perception maybe that some people basically could get away with taxes while others had to contribute more to finance the crisis. And this is the first time I saw such strong words in G20 communique. In April 2009, there was a G20 communique that say that I'm quoting here, that the G20 agreed to take action against non-cooperative jurisdiction, that they're ready to deploy sanctions, and that the era of bank secrecy is over. There was something really, I think, a key defining moment. And we've seen these changes from that moment. At the level of the OECD, you see the amount of exchange of information treaties that have been developed. It's quite an amazing exponential path. There were 17 treaties that had been signed between 2000 and 2008. Most of them implied either the US or the Isle of Man. Following these revelations and following the G20 communique, in the next year, 41 additional treaties were signed, and 6 months later, an additional 150 treaties of exchange of information were signed. So it was quite an amazing development that was triggered by all of these actions. Since then, we had the LuxLeaks, the Panama Papers, the Paradise Papers, etc. And each time, there was a reaction of the policy making, and notably in the Commission, each time a proposal to try to tackle those schemes. It started in various areas, notably the exchange of information. If you look at the number of amendments of the DAC, so the Directive on Administrative Cooperation that we had, DAC 2, exchange of information between tax authorities on financial accounts, DAC 3, the exchange of information about rulings, DAC 4, country-by-country reporting, DAC 5, the beneficial ownership, so in the context also of anti-money laundering, DAC 6, the automatic information on the tax planning schemes by the intermediaries. Also a new proposal on to protect whistleblowers, which were quite often in those cases instrumental in bringing these cases into light. And each time we had an anonymous adoption at the Council in record time. And that's very important. A EU list of third countries, that's also an achievement for tax purpose. So there was an agreement between the member states on this list and the further developments. And then the implementation of BEPS, ATAD 1, ATAD 2. So we now have a GAR, we now have a CFC rule, we now have interest limitation rule, the mismatch, the exit taxation. And again, adoption at unanimity in very, very small, short time. So my take on this is that when there is the political will, we can achieve things. And it's very important in this field. Then two elements that we will talk about in a moment. Indeed, it's in 2016, in October, the relaunch of the CCTB, and we will discuss this in a moment. And then a few weeks ago, some new proposals on the taxation of the digital economy.
Thank you. So about CCCTB, do you think it's the right response to establish level playing field in the EU? What prospects does it open to European businesses? Is CCCTB a business-friendly tool, or is it something else?
No, I think it is. It is indeed. Not only, it's more than that, but it's indeed a business-friendly scheme. At least we want the CCTB to promote growth and competitiveness of companies. As Mr. Jean-Jean said, I mean, this is not something new, these ideas of some form of harmonization of, let's say, in a broad sense, taxes. He referred to the 1970s. We can even go, beyond that. In 62, there was a Neumark committee who already had some reports on some ideas of harmonizing harmonizing taxes in the future. So in 2011, we had a first version of the CCTB that was put on the table, and it was discussed at the Council. There were discussions, and some progress were made because actually there were some discussions that allowed also already today to have a discussion that is easier because some elements have already been discussed, and so there were, for example, convergence on some of the articles already. There was no unanimity, and so the Commission, in this light, decided to put on the table a new proposal in October 2016, actually two new proposals, one for the common base and one for the consolidation, saying, okay, no, we we know more or less the positions of the member states, and we think that this may be a proposal that could actually find some support, some unanimous support. And we had in this proposal some new elements. The stage approach, because there was the feeling that it may be easier for the discussions in the Council to separate the common base from the consolidation. But the consolidation remains the ultimate goal. So don't be mistaken by this. This is still the idea to reach the CCCTB, so the free CTB, at the end of this process. A mandatory scope, so for those companies that are beyond a certain threshold, 750 million in terms of turnover. The inclusion of all the ATAT elements into the directive. So the ATAT elements live outside of the directive, of the CCCTB. There is an ATAT directive that is being adopted. But we include also those elements into the proposal. Some temporary cross-border relief between the two stages. And then two new additional elements precisely because of the issue of competitiveness and promoting growth. One being an R&D tax scheme in the form of a super allowance. So there was a design of a super allowance that was the result of our own analysis of what were the best ways to promote R&D and innovation. So we had done some studies. Notably, we have a study in 2014 that goes into this direction. And then another element, which is the allowance for growth and investment, which is indeed a form of notional interest and an allowance on the equity financing of companies. As an economist, the profit of companies is defined, of course, as the profit minus the business cost. And business cost includes the operating cost, the wages, the cost of machines, depreciation, etc., and then the financing cost. And in most current systems, there is one cost that is not deductible, and all the others are. This is the cost of the remuneration of the shareholders, the minimum remunerations that they require to continue to invest in your company. The fact that we have these differences between the tax treatment of debt and equity leads to an over-indebtedness of companies. The debt of companies is much higher than it should be, with dire economic consequences, notably, and it's some studies that we've done. The IMF has done this analysis as well, and amazingly, we reached to the same conclusion, even in terms of numbers, that having companies that have a stronger capital base is likely to decrease both the likelihood of crisis and also the cost of those crises when they occur. So the new 2016 proposal was indeed based on two elements. The first one is promoting growth and competitiveness with those new elements that we thought were necessary. On top, of course, of the simplification that a CCTB would bring in terms of managing currently 28 potentially tax systems. But the other one was also fairness, tax fairness, which is an element on which we were very keen to introduce, notably in terms of leveling the playing field. It's not a proposal that is against multinationals or companies, etc. But we feel that there is a necessity with the CCTB to level the playing field between all the companies. There is an interesting element, actually, and David was mentioning the BEPS projects, and I've been following more closely as head of the economic unit, the Action 11, which is the measurement of the BEPS. And one of the interesting elements that I find, there are many interesting elements and findings in the OECD report, but one of the elements that I find interesting is the fact that companies that have the possibilities to have tax planning activities have actually a higher markup than those who don't, controlling for all their characteristics. What does it mean? It means that they are much more profitable in the sense that the margins of those companies is higher, and it's actually not passed necessarily to consumers. And this is something that we need to address. Maybe I stop there. I think that both the R&D and the AG, I mean, as we propose, had the potential also to increase investment, because there were schemes that were also designed in their provisions to try to spur and promote the investment of companies in the economy. And there were elements of competitiveness indeed in the proposal.
Thank you very much. Obviously, we will have many, I would say, political discussions later in the day with the two rapporteurs of respectively CCCTB and CCTB, Alain Lamassoure and Paul Tang, with us this afternoon, and as we know, Commissioner Moscovici concluding the day. But perhaps, do you want to react very briefly? You have 1 minute on that. Oh, okay, I'll give you 2 minutes. On the last report of the European Parliament adopted in March on CCCTB. Obviously, it's a huge topic, and it will be discussed again this afternoon, but do you have any sort of general reaction on it?
No, I think first of all that both Alain Lamassoure and Paul Tang have been doing an amazing job. The reports are good, and they've been able to adopt them with a very large majority in the European Parliament. And so it shows that there is a broad support from the European Parliament in favor of the CCCTB project. And I think that it's a very good sign. Of course, there may be differences between what the Commission had proposed and what is in the report. So there are some elements that are not in. There are new elements that are in and that will deserve indeed some considerations. The project is now at the level of the Council. Is being discussed. Discussions are taking place, and I'm very optimistic personally on the prospect.
Thank you. Let's move on to our second theme, which is the tax competition between countries. Obviously, tax competition between countries is absolutely nothing new, but there's a number of key elements that have been added to the game in the past few months, I could say, or small number of years. The biggest of which is probably the US tax reform that was adopted in December, which, as we know, reduces the headline corporate tax from 35 to 21%, introducing, interest limitation as well, very much like in the ATAD, introduces new base erosion and anti-abuse tax, a global intangible low tax income tax. So what does that mean for us? I mean, what landscape does it create? David, do you think it has a huge impact for the rest of the world, both for US corporates, non-US corporates? How do you see the consequence of this US tax reform? And do you see it as a game changer, really? Or is it fine? It's part of the landscape, but life goes on as it did before in the rest of the world.
Look, I think it would be an understatement to suggest that this was not a significant tax reform in the scheme of not only the US taxation system, but globally. And I think it's the infrequency of major reform in the US that is quite striking to begin with. So these big reforms, they don't happen all that often. So when they do, I think it is only reasonable that other countries and stakeholders around the world take notice. And I think it's fair to say that that's what's been happening here. In addition to that, when you look at a reform that involves such a substantial cut to the corporate statutory rate, I think you would be fooling yourself if you didn't think that that was significant. It is significant, and as Gaëtan will tell you, and plenty of people in my team will also tell you, effective tax rates are probably much better indications than statutory tax rates, but at the end of the day, there will always be some degree of signalling involved when a country makes such a big statement to cut its statutory rate as aggressively as we've seen. Now, what that means and what the implications of that will be, along with the whole raft of other measures that are included in the package, is something that it really is difficult to draw any strong conclusions about at this point in time, because the interaction of all of these measures can be quite complex. So just thinking about what some of the key measures of the reform are, clearly we are seeing, at least in some respects, more of a shift towards a more territorial system. We see the cut in the statutory rate. We see things such as the deemed repatriation tax, the toll charge, which essentially is deeming a return, or deeming the return of all of that money that has been held offshore, which has been a quirk within the US tax system that has had consequences and implications for tax planning globally for many years. So there's no question about that. So to see the US impose the changes that they have in that respect is something that I think reinforces some of the other measures that you mentioned, Thierry, about the BEPS related elements of this package. And there are some very strong BEPS-related elements of this package, which is interesting because when we went through the BEPS project, every second conference that I went to, the most commonly asked question was, but are you going to get the United States to agree on all of this? And I think what we're seeing with US tax reform is, at least certainly around questions that are BEPS-related and underpin the substance of the BEPS package, that this is now a global consensus and it's being implemented beyond the minimum standards in the US. I think if you think about some of the other dimensions to the US tax reform, in particular, if you look at the measures in relation to the writing off the investment, immediate expensing of investment, that combined with the cut in the statutory rate has had a really significant, and will continue to have a significant impact. So I think that the statutory rate is important. It has a big impact, particularly from a signalling perspective. And just to put that in context, the US had been at the top of the OECD in terms of its statutory rate. And the way we generally try and measure these things is we look at a combined rate. So we look at where states impose the corporate income tax, what might be the combined rate in a jurisdiction. And the US was always, so that takes you above the 35 to closer to 39 in terms of where the US was. The 21 statutory rate, when you factor in state taxes, it's really getting you back to around the OECD average. But of course the OECD has much variation from being in the low teens, or in some cases countries that don't actually impose a corporate income tax as such, through to having countries that are above 30%. But there's no question that some countries, from a tax competition perspective, have generally been able to get away with higher rates than others. And I think that there are some characteristics that might be attributed to countries that have been able to manage a steady flow of investment with relatively high rates. When you are the largest economy in the world and so much innovation and genuine activities occurring in your jurisdiction, then you probably have some ability to continue to attract investment that smaller open economies may not have. So the US has probably been able to get away with that for longer than most, for a range of reasons. Having said that, when the United States moves to 21% on a statutory rate, I think that other countries will take notice and will respond, and some have already begun to respond. Now, what that means in the medium to the longer term is a question that I don't think any of us have the answer to. What we have been seeing over a period of time has been reductions in corporate statutory rates. Certainly, the work that we've done at the OECD shows that in the lead up to the crisis, it was only one direction. Rates were all coming down, and pretty aggressively over a period of time. Then we had the crisis and there was actually a bit of stabilisation. But now that we've passed that hump of the crisis, even before the US tax reform, we have seen countries now go back to cutting the statutory rate. So I think that with the US acting, that will put more pressure on other countries. You will see countries respond. What that means and what that means for the future of the corporate income tax is something that I think will be the subject of much of our study and ongoing investigation, and I'm sure that the Commission will be doing the same. Just to make a couple of observations, and that is to say that when you look at the corporate income tax as a share of total revenues across the OECD, it's about 8 to 9%. So, we spend a lot of time talking about the corporate income tax, but it is a modest contributor to overall tax revenue levels. Having said that, when you calculate what that is in dollars or euros for any given country, it's too much for anyone to give up on in a hurry and any time soon. In addition to that, I think that the corporate income tax, depending on other characteristics in a system, but the corporate income tax has always played an important role as a backstop to the personal income tax system. In an environment where an individual, as a shareholder, a contributor of capital, may otherwise be able to avoid paying tax on an ongoing basis through the benefit of deferral, of having that money and income and wealth accumulating within the corporate vehicle. Corporate taxation on an annual basis is one important means of ensuring that you have some augmentation of the personal income tax system in that sense as well. So for a whole range of reasons, I think there are some very strong arguments as to why the corporate income tax is certainly, what was the Mark Twain quote was, rumours of my death have been greatly exaggerated. I think when it comes to the corporate income tax, rumours of its death have been greatly exaggerated. But I think that we will continue to see some reasonably aggressive competition on rates. What will be just as important will be having a look at what countries do with the base. And bearing in mind, if you take the US reform, they've done some things that broaden the base, and that needs to be taken into account. And the other dimension is that the immediate expensing of capital investment, that is not an ongoing provision. It is time limited. Now, quite often in the US, we've seen things that are time limited that just go on and on and on as if they were indefinite anyway. But that can't be taken for granted. So I think you need to take all of these things into account. But this reform has been of such a visible and aggressive nature in terms of the cut to the corporate statutory rate that I think anyone that says that that's not going to have an effect on rates elsewhere is really understating the impact.
Thank you. Gaëtan, I have two questions for you. The first one is, do you think CCTV is still adapted to the new context created by the US tax reform? That's one question. But the other question is, obviously, international tax competition or tax competition between countries is not limited to a transatlantic game. Obviously, it's a big EU issue as well. EU is far from being exempt from competition between its member states. And as David just said, we've seen a clear downward trend on corporate income tax rates. But do you think the tax rate is the whole story? Should we go further? Does it tell us everything? I mean, can we analyze effective tax competition between countries beyond tax rate? So if you could shed some light on those two issues.
Yeah, maybe if I may also say a word on the US tax reform, and I certainly agree with what David has said and echoes this. There's a lot of discussions at the moment on some of the specific provisions, the GILTI, the FDII, the BEAT, etc., which are important provisions which will have effect, in particular maybe for some sectors or some type of activities. But fundamentally, there are some other provisions in the US tax reform that I find quite interesting as an economist. First of all, it's not something that comes out of the blue. It's something that has been discussed at least since the presidency of George W. Bush. There were already presidential panels on tax reforms, etc. And there's been a long debate in the US on the need, notably, for example, to move to a territorial system the US was one of the few remaining countries in the world to retain a worldwide tax system. So huge decrease in the rate, 35 to 21%. But what I find interesting as an economist, indeed, is and even if it's temporary, the immediate expensing part. And this immediate expensing part, for economists, it's a system that comes quite close to the effects of cash flow taxation. Because you can immediate expense what you have. But on top of this, the US has retained the deductibility of interest payment. And from an economic viewpoint, the economic reasons why we give a deduction of financing cost is to compensate companies for not being able to immediately expense their investment. And that they need, because they need to depreciate over time, they need to finance basically this depreciation. And here we have a system that cumulates the immediate expensing, temporarily I agree, but also with continuing interest deductibility. And I think this has a profound effect on effective marginal tax rates and hence on investment. Impact on what we do, I think indeed this triggers or needs to trigger a reflection on the type of corporate systems that we want in Europe. And notably, and I'm back to the 2016 proposal, the type of competitiveness of the system that we want, the degree of competitiveness, and how we need to respond. A word on tax competition, because I think that indeed we see interesting things. First of all, we need to define tax competition. And one definition I often have in mind is the interdependence in tax setting to attract a mobile tax base. So interdependence means one country changes rate, leads to a reaction of others that will go in the same direction. But also, this has a purpose, it's to attract or retain a tax base that is mobile between the various jurisdictions. There is evidence of this, at least there is evidence of the interdependence in tax settings. So we have a range of the academic literature that looks at those. It's really recent, actually, because it's interesting to see the development in this. It's only for the last 10, 15 years that the econometric techniques have been developed to deal with this, with the area of what you call spatial economics. Because we have a circularity, of course. So the rate of a country depends from the rate of the other one, but the rate of this other country also depends on the rate of the first one. So you have some difficulties to do this. It was not unusual in the late 70s, early 80s to have corporate tax rates that were in the range of 40, 45, 50%. And today, the average rate is around 21, 22%. So you have seen a gradual decrease in rates, and indeed, David also mentioned that this leveled off a bit during the financial crisis. But over the last 20 years, this rate has decreased from 35% to now 21, 22%. What does it mean for tax collection? And that's one of the puzzles of what you call the tax revenue puzzles, is that tax collection is, of course, fluctuating, and notably with the economic cycle, but has not necessarily gone down. Of course, it depends on your points of comparison. Changing 1 year of comparison may actually change the picture, but by and large, you see that those CIT collection always varies between 2 and 3%, depending on the member state. Some have more, some have less. It depends. I looked at this, and it's actually work in progress that is not yet published. But if you compare 95 and 2015, so 20 years, you see that the ratio of CIT collected to GDP increased by 0.2 percentage point. And what you can do is to try to decompose this into the different factors. You do a differentiation of this, and you see the effect of each of the components. If you look at the effects of the rate decrease, all other things being equal, and of course not all other things are equal, but all other things being equal, if we would have experienced the decrease in the rates as it is without anything else changing, the ratio of corporate income tax collected to GDP would have decreased by something close to 0.8 percentage point. So we are on average 2.5, and we would reduce this to something like 1.7. But what happened at the same time is that we had an enlargement of the tax base of something close to 0.9, and an increase in the size of the corporate sector also of something between 0.1 and 0.2. So we had indeed the rate cut cum base broadening that we have experienced over the last 20 years that has been able to cushion the CIT collection. However, if you look at this for the last years, you see that we may reach actually a limit in terms of base broadening. Is that all the specific regimes, provisions, etc., that were in place basically have already been tackled by the base broadening, and that this continued reduction in the rates, and we'll need to see what will happen with the reactions to the US tax cut, may actually not be sustainable anymore, in the sense that we will not be able to broaden the base larger than what it is today. So there's some sort of warning there that needs to be taken into account. Last word on tax competition, tax avoidance. Tax avoidance itself by companies is mainly driven by differences in statutory rates. And that's indeed one of the reasons why these tax cuts may have importance, is that this is one of the factors driving the shift of profit from one jurisdiction to the other via the use of debt, via transfer pricing, via the use of IP schemes. What is also interesting, and this is my last point, is that since the beginning of the financial crisis, you see indeed some leveling off of the decrease in the statutory rates, but you also see the rise of specific regimes, and notably, for example, patent boxes. The number of patent boxes was close to 1 or 2 in the EU before the financial crisis. Now we are above 10, I think it's 11 or 12 or something like this. And the use of these specific regimes may indicate also some new type of, let's call it with brackets, tax competition, at least to attract some specific activities or revenues that touch the base and not anymore the rates.
Thank you. Let's move on to the third and final theme of this session now, which is digitalization and the tax challenges arising from digitalization. Obviously, for David, there is an absolutely obvious question which is going to come up, as we all saw the interim report on tax challenges arising from digitalization that the OECD released to the G20 finance minister a month ago, more or less, 5 weeks ago, something like that. So there's going to be an obvious question for you, David, here. And obviously, in the EU/European Commission context, if I remember well, on the 21st of March, the European Commission released 2 proposals. One presented as the long-term solution to be a common reform of the EU tax rules for digital activities, and that is based on taxing profits with a number of thresholds. If you meet one of the following thresholds in one member state, 7 million annual revenues, or 100,000 users, or 3,000 business contracts, then you get taxed. And the second proposal, which is an interim solution, presented as more short-term, which is about taxing certain revenues from digital activities, which, as we know, we've all read in the press, wants to levy 3% of revenues, this time, not profits, on companies that generate digital activity above 750 million euros worldwide and 50 million in the EU. So that's the context. And now the specific questions to our 2 guests. First of all, for David, obviously, if you could present to us, the main measures contained in the interim report. I understand you had a major personal role in that report, so you're probably one of the best placed persons to speak about it. What's at stake? What are the next steps? What are we talking about here? What's going on? And the other question for you is, obviously, the OECD is an organization based on consensus, and perhaps you've been critical of one-sided initiatives, or if not critical, you may say, hey, look, there is no consensus, so how do you go about dealing with that situation? What's your approach? I mean, what's your view? What should be done?
Well, I think I can answer the two questions together by just sharing with you where we got to on the interim report. And the word I want to emphasise is interim. It was never intended to be a final report. It was part of a process of working towards a final report that we had been mandated to deliver by 2020. Originally, in fact, the interim report was due by the end of 2018. Then the G20 finance ministers in Baden-Baden brought forward the timetable and said we want it by April 2018, and then we actually managed to deliver it in March 2018, which was no mean feat, and certainly a lot of hard work from our team to deliver that. In terms of the interim report itself, there are a range of chapters. I'll focus in on the ones that I think are of most interest. In particular, there's a chapter on business models and value creation. There is a chapter on the long-term tax challenges, and then there's a chapter on interim measures. Separate to that, there's a chapter, a special feature that looks at some very interesting things. I won't reflect on them in great detail now, but it's well worth having a look at. Looking at things such as how using digitalisation, tax administrations might be able to do their work even more effectively. So that's the special feature. In terms of the business models, where we got to in Action 1 was to say, well, we need to do more work to understand the business models of the digital economy. And the Action 1 report in BEPS was addressing the tax challenges of the digital economy. That's what it was called before the project started, and that's what the front cover of the report said. But one of the key findings of that report was, back in 2015, was it's really difficult to talk about the digital economy because digitalisation is a transformative process that is really starting to pervade the entire economy, and very few businesses are immune from that process of digitalisation. So what we really should be focused in on is the impact of the digitalisation of the economy and what the tax challenges arising from that are. And so that there's an important shift in language between the Action 1 report and the interim report, and that's the reason for that. So we look at certain business models. We focus in particular on the key features that we observe in certain highly digitalised business models. Now, what is a digital business? You hear people talk about digital businesses all the time. It's a really interesting question. But what we did in the business models section was we looked at some of the elements of the infrastructure of digitalisation, but in particular we looked at certain highly digitalised businesses and tried to observe what some of the key features that we sometimes see might be. And we came up with three key features. The first one being what we described as scale without mass. This is the idea that you can expand and grow into a business, a firm that has a global economic footprint, but in terms of your physical presence, you can be a fairly small operation. You know, we all know the stories of global groups that have emerged out of people's garage or bedrooms. You know, that's the nature of what digitalisation allows, is this scale without mass. The second feature that we observed was the growing reliance on intangible assets as key drivers of these businesses. And, you know, for me, I guess the use of algorithms in particular is just a really stark example of the significant reliance of many of these highly digitalised businesses on intangible assets to drive value in their business. And the third element was around this notion of user contribution or user participation. Now, I think it's worth noting that that this is not a feature that's present in all businesses. Certainly it's a feature that we observe in some of these highly digitalised businesses. And what the inclusive framework on BEPS, what all of our member countries ended up agreeing on was that those first two characteristics, they actually have some application to all businesses. But it's that third element that's somewhat unique to certain highly digitalised businesses. Now, it is true that in the past, less digitalised businesses have had some degree of participation from users or consumers, you know. That has always been a very small component of the business, but what we're seeing now is a much bigger part of the business. So that's where we got to, but then not only did we look at, well, what are the key features? We had to look at, well, what does that mean for value creation and what does that mean from an international tax perspective? And on that point, our countries were divided into two separate camps. One view was that this user contribution, and it all rested on user contribution, that this user contribution is a new form of value creation. And for an international tax system that allocates profit and taxing rights and allows countries to tax that profit based upon where the value is created, then there needed to be some allocation of taxing rights to those jurisdictions where the user might be. So you can all think of the platforms or some of the global businesses where they may have a huge user base in some jurisdictions, but they may not necessarily have a very large physical presence and they may not necessarily be involved in other contractual activity in a traditional customer-supplier type relationship. And what is often a characteristic here is these barter transactions where someone allows you to use a service and in return, implicit, maybe less known in the past, certainly more known today, the users are giving over their data and that is a barter transaction that's occurring. So difference of opinion there. And that's quite significant because if you take the first view that this is about value creation, then that leads you to certain conclusions about how you need to change the tax system internationally in order to reflect that. The second view was the view that says, well, actually, these barter transactions are essentially no different to inputs that are sourced from third parties by a business in any other context. So I'm a business, traditional bricks and mortar type business, and I acquire fuel in order to run my machinery. Now, I pay value for that, I get the input, and that helps run my factory, my operation. And so that second view was to say, well, you know, whether money is actually paid or whether there's a barter transaction, it's essentially an independent third party, the user, and the nature of that transaction is one of saying, well, we give you something, can you give us something in return? But you're not creating value in my business, you're simply providing me with an input that I then put into my business and generate value, and it's where that activity generating value occurs is where the taxable profit should be allocated. So that's an important point of difference there. The other chapter on long-term challenges, or the chapter on long-term challenges, really said that the two key principles that are at play here are around nexus, or the sort of permanent establishment definition, and profit allocation rules. And on this, I have to say that across the board, there was agreement to undertake a coherent and concurrent review. And I underline the word concurrent because both these things have to happen together, nexus and profit allocation. But there was a commitment to undertake that review in order to try and find a common consensus on that. But having said that, within this set of questions, there are broadly three groups of countries in terms of where countries currently stand. So yes, to answer your question, Terry, we are a consensus-based organisation, but where we disagree, it's also important to articulate where those points of disagreement are. And I think that some people look at the interim report and they say, well, it just shows how hard it's going to be in order to get global consensus. And at one level, that's absolutely correct. But I think the more important insight is to really recognise that if you don't go through that first exercise of identifying what the points of difference actually are, you will never ever be able to get into a position where you can bridge the differences between those positions. So the three groups of countries that existed were, at one level there's a group of countries that says, look, the BEPS project was important, it's ongoing in terms of its implementation, we think it's done a pretty good job, and frankly we don't think there are any major reforms needed to the international tax system, and we think, at least at this point in time, we need to wait and see. Not a large group of countries, but there's a group of countries that are in that particular group. Second group are those that say, well, it's all about user contribution. What we've really seen here is that's the big change, user contribution, and what we need to do is we need to have a look at how we can better reflect the contribution that users are making to value creation of businesses, firstly by having permanent establishment rules that recognise that even if you don't have a traditional presence or a physical presence in a jurisdiction, if you have a large user base, then that should be sufficient. And then secondly, we need to have a look at how we allocate profit through the profit allocation rules to ensure that some is allocated to the place where the users are located. Then there's a third group of countries that take a different view, and their view is that most of what is actually occurring in the so-called digital economy is actually, these are changes that are driven partly by digitalisation, which is affecting all businesses, but they're also driven by globalisation and have been driven by globalisation over a period of time. And for this group of countries, any response to those challenges, and they don't deny that there are challenges, they recognise the challenges, but they say any response to those challenges should not seek to target or ring-fence certain digital businesses, that they actually need to be more principled and have application right across the economy. Now, obviously, if you take that view, then you may well be prepared to contemplate even larger reform to the international tax system than those in that second group that want to see targeted reforms to permanent establishment and profit allocation rules. Just to move to the other significant chapter before I hand over, we also have a chapter on interim measures. And I just want to be clear on where we got to in the interim report. Firstly, there is no consensus on the need for interim measures, and we make that very clear in the report. There are some countries that were strongly opposed to interim measures, but then there were some countries that really want to implement interim measures. And the position that we took was, no consensus, we're not recommending any interim measures. But then, among those countries that at least have expressed an interest in wanting to implement interim measures, we had a discussion around, well, what might be some of the design considerations or the key considerations you need to take into account to minimise the harm and to minimise the spillovers of any interim measures if in fact countries choose to go down that path. And without going through them in detail, they involve things like, firstly, making sure that you are compliant with your obligations under your double tax treaties. Secondly, making sure you meet other international obligations, of which trade obligations are certainly key there. Also making sure that you don't target smaller businesses and in doing so end up stifling innovation amongst those small startups and businesses that might actually bring some competition and bring that new wave of technology and developments that we're looking forward to. In addition to that, ensuring non-discrimination in the way in which measures might be implemented. So, a range of considerations there, but it was really about saying, firstly, we do not agree on the need to introduce these measures, but those countries that are thinking about it turn their mind to the questions of, well, how might something be designed in a way that avoids some of those spillovers and those harmful effects? And that's set out clearly in the chapter. So moving forward, we have a commitment to undertake that concurrent review of nexus and profit allocation rules. We will provide an update to the G20 finance ministers in 2019, and we are working towards the delivery of a final report as originally envisaged by 2020.
Many thanks. Gaëtan, European Commission tabled two proposals on 21st of March, long-term solution, short-term solution. I was wondering if you would want to elaborate on how the Commission came up with the criteria on really each of the two proposals, if you think it's worth elaborating on this. And then more specifically on each of the two proposals. On the long-term solution, obviously it could impact CCCTB. It seems to have its own life, but it's not unrelated to CCCTB. How do you make the two compatible? Are they compatible? Are they supposed to merge at one point in time? I mean, what's going on there? And on the short-term solution, obviously, we've heard a lot of criticism of this proposal. Is this proposal a technical solution, or is it a political signal? And if it is a technical solution, is it compatible both with the proposal for, well, the long-term solution and with CCCTB? So what's the momentum there, both technical and political?
Yeah. First of all, the point is that I think there is a consensus on what the problems are. And even those countries that agree or disagree with the measures, actually, we all aligned on understanding the nature of the problem. Maybe we should not call it the original sin, but it dates from the fact, well, it is from the fact that our current international tax system is outdated. It dates from the League of Nations, the 1920s. In 1920, there were barely any cars in the streets. In 1920, there were no computers. In 1920, the OECD and the EU were not even existing. And at the time, the leaders, the experts that looked at the way to do the international tax system based these international tax systems on three key elements. The first one was the fact that to be able to tax a company, the jurisdictions needed to ensure that this company had a physical presence. The second one is that all the disputes between member states on the allocation of profit would be dealt with transfer pricing rules. And the third one is that there was no need at this time to have a multilateral tax treaty that basically the various countries could deal bilaterally and have a set of bilateral tax treaties. So the problem we have today is that the business model of the time are not those of today. Even beyond the digital, we have business models now that are totally integrated and where even transfer pricing rules that are not digital are sometimes very difficult to assess and for tax authorities to comprehend. So two aspects that needed to be addressed for dealing with the digital economy. One, the issue of going beyond the physical presence. Companies are now able to have activities and indeed to create value in some countries without having a physical presence. So the need to address the definition of, when are you a permanent establishment? And then the second aspect is the allocation of profit to these permanent establishments and the rules to allocate those profits. I think there is a consensus on understanding the issue of the problem. There was the work of the OECD that started with, indeed, a long time ago also, and with BEPS, this Action 1. In the Commission, we also had a group of experts that looked at those issues. And we had also requests from the member states to act, or at least from a number of them to act, to do something. And what the Commission has tabled a few weeks ago is a package with actually three elements. So we don't have a short-term or long-term solution. We have a comprehensive solution and an interim solution. We prefer those names.
Apologies.
So the important element, the comprehensive solution, is the redefinition of what constitutes a digital presence. And so this indeed addressing, for the long term, but for the consensus also that will need to be found also at international level, the definition of what is a PE and how to allocate profit to this. And there we have some criteria that, I mean, as soon as you fall into one of the criteria of number of users, number of business contracts, or number of revenues from the digital service, you may actually have a digital presence or presence that defines a permanent establishment. Then we have an interim solution, which is the digital, sorry, next to the comprehensive solution, we also have a recommendation for the member states to try to implement similar rules vis-à-vis third countries, because the directive would only apply within the EU. The directive would not basically say overrule, if you want, the tax treaties that member states have with third countries. But we have a recommendation asking member states to try to negotiate and implement similar rules vis-à-vis third countries. Then for the interim solution, we have indeed a tax on revenues, 3%, on some revenues, and that also limited to some companies and some activities. So some companies, those that are worldwide beyond a certain threshold, the famous 750 million revenue threshold worldwide. And then within the EU, 50 million revenues from those digital activities. And they are business model, because we don't tax new companies or we don't tax sectors. We really tax certain type of activities. And these are those that require actually the use of data from the users, where the data, where the value creation is linked to the use of personal data. And that's notably things like targeted advertisement, and this is things also like the intermediation platforms where you try to bring suppliers and consumers into exchanging information or exchanging items. There was a narrow path for all of these criteria, and David mentioned it. So it needs to be compatible with the EU legislation, first of all. It should not discriminate. It should be WTO compatible. There is a need also to respect the double tax treaties. You cannot do a new VAT. And so there was a narrow path, and I think that we found a system that is able to address the need or the wish of some member states to act, and the proposal is on the table. What we need to see also is the counterfactual. Is one of the things that is, as Commission, we are a bit worried about, is that there are individual initiatives that are mushrooming. And we don't want to end up with a situation where each member state would implement its own interim solution, where it would basically put at stake the single market, because all these solutions may be different. There would be difficulties for the companies actually to deal with 28 different systems, and they may not be compatible with each other. So indeed, we've put a proposal on the table that is a feuille de route, if you want, on if you want to do an interim solution, well, this is what we think is the best solution. There were some criticism, of course. Some countries like it or don't like it. I think that on the analysis, I haven't heard any criticism, frankly. I think it's more on the political wish of doing it or not. One of the things that is funny also is that I hear some that says, well, actually we agree with you that it's impossible in the current system to tax profit. And so we say, okay, but then we have a solution that tax revenues, and then they say, no, you should have tax profit. But it's precisely the difficulty, and that's where I think there is a bit of difficulty with the proposal. But otherwise, so those are there. The discussions in the council will start. The link with the CCTB, maybe to finish, those directives have their own life. So even without the CCCTB, if the comprehensive solution was adopted, it would be actually for all companies, well, at least those that are within the threshold that is set in the directive. we could have adapted the CCCTB to this, but that would have meant to withdraw the proposal and to put a new one on the table, which, practically would have difficulties. The Parliament already had its opinion on it, and the discussions are in the Council. So I think that it will be now up to the Member States in their discussions to see how they can include those elements into the CCCTB. So the definition of what's a PE and the definition of how to attribute profit, and possibly, but that will be part of the discussions of the Council, to see whether they want for all or for some specific sectors to look at the formula apportionment and have an aspects of use of data. At least that's what the reports of the Parliament are suggesting. But this is now a matter that will be dealt with by the Council.
Thank you very much to the two of you.